as President Trump casts hungry eyes toward what he touts as the world's largest oil reserves buried beneath Venezuela's sands. Major international oil companies remain far from salivating at the prospect of returning to a nation plagued by chronic instability and predatory politics. To strategically crowd in much-needed investor interest and enthusiasm from skeptical energy executives, the U.S. Energy Secretary has scheduled critical high-level meetings with top American oil industry leaders specifically on December 7th to pitch the Venezuelan opportunity. ExxonMobil, Chevron, and ConocoPhillips executives are likely being formally briefed on the potential Venezuelan investment landscape and associated risks, according to detailed reporting from energy sector insiders tracking Washington-Caracas negotiations. This high-stakes briefing arrives directly after President Trump's bold public claim, asserting confidently that Venezuela stands ready to immediately supply the United States with between 30 to 50 million barrels of desperately needed oil on favorable terms. However, for Trump's optimistic scenario to ever materialize into reality, analysts warn that at least 5 major insurmountable obstacles must be systematically overcome before big oil would even consider returning to Venezuela. CNN analysis. Venezuela's state-owned oil behemoth PDVSA continues being tightly run by the country's still powerful and deeply entrenched military generals who wield unchecked authority over operations despite the political upheaval. Amid decades of suffocating U.S. sanctions designed to choke revenue streams, this military-dominated entity ruthlessly controls virtually all domestic oil production quotas, along with dictating much of what happens throughout the entire downstream oil export chain. There exist substantial and complicating Russian joint ventures alongside massive Chinese creditor financing arrangements deeply interlinked throughout Venezuela's entire opaque oil value chain from extraction to international marketing. If American oil companies dare return to restart shuttered fields, they fundamentally need ironclad assurances about precisely who truly runs Caracas power centers and whether expatriate personnel, drilling rigs, and multi-million-dollar equipment investments will remain physically safe from sabotage or nationalization. Tai Lu said, and I quote, "As a first step, U.S. oil companies would need some type of security guarantees and reassurances, and be confident that their personnel and equipment would be safe on the ground." Unquote. To even attempt fully restoring Venezuela's dilapidated oil industry back toward viable production levels, returning oil companies must comprehensively rehash and rebuild the entire decayed upstream and midstream infrastructure from ground zero. Remote production sites will desperately require tens of thousands of miles of new hardened pipelines, modern drilling rigs with advanced deep well capabilities, upgraded export port infrastructure, and most critically reliable baseload electricity generation capacity. Experts conservatively estimate this Herculean industrial reconstruction would demand sustained capital expenditures exceeding $10 billion annually across multiple years, while taking well over a full decade before generating positive cash flows. By the time such long-horizon investments finally mature into profitability, America could realistically find itself on its 49th president, while Venezuela simultaneously confronts violent anti-U.S. popular uprisings or socialist revanchist coups overturning agreements. Major oil companies will demand explicit sovereign guarantees that future incoming governments, regardless of ideological orientation, simply won't retroactively change unfavorable contract rules, royalty structures, or tax codes years down volatile political timelines. The United States continues attempting to strategically maintain a suffocating comprehensive oil embargo regime specifically targeting Venezuela, while maintaining multi-layered sanctions crippling its petroleum export capabilities worldwide. Meanwhile, Venezuela's hydrocarbon ministry enforces draconian domestic laws, compulsorily requiring all petroleum businesses to remit punishing 30% royalty fees alongside confiscatory 60% income tax rates that obliterate potential returns on capital. For global oil giants contemplating fresh, massive capital injections into Caracas-controlled fields, these extortionate fiscal laws absolutely need comprehensive legislative repeal, adding yet another formidable political hurdle amid post-Maduro chaos, CNN reporting. Hence, only those companies possessing the most advanced heavy oil extraction technologies and refining capabilities will demand dramatically more attractive production-sharing contracts, containing ironclad fiscal stability, clauses protecting against regime change risks. Back in 2007, under Hugo Chávez's radical nationalization drive, European majors Eni and Repsol, alongside American supermajors ConocoPhillips and ExxonMobil, suffered catastrophic asset seizures before being violently kicked out of Venezuela entirely. These aggrieved firms collectively continue pursuing tens of billions of dollars in rightful compensation payments still owed by bankrupt PDVSA through international arbitration tribunals and U.S. court enforcement mechanisms worldwide. Energy experts warn these corporate giants vividly remember the expropriation trauma, financial losses, and diplomatic humiliations from last time around, and absolutely won't contemplate returning without full upfront repayment settlements finalized. Venezuela would simultaneously need to painstakingly regain meaningful access to frozen global capital markets that have comprehensively shunned the pariah autocracy for nearly 2 decades due to serial sovereign defaults and creditor mistreatment. Credible financial guarantees backed by sovereign commitments alongside comprehensive reimbursement mechanisms for past losses and nationalizations may prove utterly crucial and decisive toward realistically attracting risk-averse major oil companies to commit billions in fresh capital toward reviving Venezuela's long-dormant production fields. S&P Global Energy's comprehensive broader long-term global oil supply and demand forecast models remain completely unchanged and unmoved despite this dramatic Venezuelan political shocker that has dominated energy headlines and commodity trading floors worldwide. Venezuelan Orinoco Belt crude grades characteristically prove notoriously heavy and viscous, literally twice as dense and heavy compared to conventional Middle Eastern benchmark barrels, while simultaneously exhibiting prohibitively high sulfur content that demands expensive specialized pretreatment processing. This challenging technical profile stands distinctly and fundamentally different from the lighter, sweeter crude oil grades that American Gulf Coast refineries remain specifically optimized, configured, and economically calibrated to consistently process through their existing complex distillation towers and upgrading units. Consequently, and unavoidably, only certain highly specialized delayed coking and hydrocracking refineries strategically located around the world possess the requisite advanced upgrading capabilities and infrastructure investments needed to viably handle, process, and profitably convert this particularly stubborn extra heavy sour crude into usable refined products like diesel and gasoline.